Hi, welcome to Numerix video blog. I'm your host, Jim Jockel. Joining me today for the third year in a row with his market outlook, Kevin McPartland, head of market infrastructure and research at Greenwich Associates. Kevin, how are you?
Good, Jim. How are you? Happy New Year.
Happy New Year. And just looking out the window behind you, I'm hoping that your outlook is a little bit more rosy than the weather today.
Yes, I think the clouds will part hopefully sooner rather than later.
Well, let's start with some good surprises in the end of last year in terms of market performance. And in your new report, kind of on your top 10 imperatives looking for the new year, you kind of talk about the Trump bump continuing as we're a couple days away at this point to the inauguration. What's the near-term market outlook, and do you expect the Trump elements to continue to have positive trends on the market right now?
It's hard to talk about 2017 without talking about the impacts of Trump and maybe more importantly of Republican Washington in general. So talk of scaling back capital markets regulations are not grazing anymore. There's a lot of reality there. Full-scale repeal of Dodd-Frank, for instance, that's not in the cards. That's not good for anybody. But right-sizing, as we called it, some of the rules, especially when you get down to the SEC and the CFTC level, I think are hard to ignore. And while the market was initially afraid of Trump winning the election, now the thought that we will have lower taxes, higher government spending, which would then lead to inflation, is really driving a lot of great volume in the markets. And obviously volatility, because there's still a good amount of uncertainty. But those things are generally all good for most of the major market participants.
So, in talking a little bit about market performance, I mean, obviously, we're all waiting for the markets to move over 20,000. But, obviously, some things are really expensive at this point. In your research, you talk a little bit about ETFs, and there's still room there within the current valuations. What's the outlook in terms of other investments other than equities at this point?
ETFs are certainly a continued growth story. Fixed income ETFs in particular, an area we continue to research pretty heavily. There's a lot of demand there. The fixed income markets in general always looking for new solutions for investors to get exposure. If ETFs were once a retail product, increasingly they're an institutional product and used in a variety of ways. A derivative, both a derivative replacement, but also a complementary product, derivatives, for instance. So we see a lot of growth there. The interesting thing to watch for ETFs, now this is more over a couple of years, as we move closer and closer to passive, and that gets more popular and the assets under management grow, we would assume that over time we would see sort of growth and active, the active strategy opportunities would start to come back because there would be less people in those areas.
Well, one of the things, in terms of putting things in a dark light, you apparently are in a dark light at this point in time. But that kind of takes a little bit of interesting thing. The element of ETFs, you also make the statement of futures are getting more popular. So that feels a little contrary. What's your thoughts there?
It's a great point, right? So, ever since Dodd-Frank was passed and swaps clearing became a big story, there was an assumption that futures sort of come and take over the swaps market. That certainly has not happened. Swaps are there for a reason. They've always been there for a reason. And in fact, clearing has made trading swaps easier and more efficient rather than harder and more expensive, as many people expected. Of course, with some exceptions. But I think what we're seeing is sort of a rising tide lifting all boats, and that there's just more interest in gaining access to certain fixed income products or exposures that swaps also focus on. So we're seeing growth continue. Volume growth at the CME for a lot of their fixed income futures. We expect to see slow but steady growth in credit futures over time as well. Another area that really is ripe for sort of new product innovation. So futures getting more popular. I don't think that will be at the detriment of anything. I think that will be alongside continued growth, as we said, in ETFs and the continued move forward in the swaps market.
And what's your thoughts in terms of the rate environment at this point? I mean, we've seen rates being raised. I think the consensus is we're going to see 2 rate hikes here in the U.S. Over the next 12 months. How does that play into some of your market outlook?
I'm going to stay away from pretending to be an economist and determining when rates will rise, but the the fact that there is a little bit more uncertainty now about rates rising, that we saw such a dramatic increase in the 10-year Treasury yield since the election, the Fed taking some action finally, it leaves everybody a bit more uncertain as to what will happen. Uncertainty, requires hedging, and it generally creates volatility. Both things that tend to be good for market volumes. So from a market structure perspective, those are great things to see. Those are good for the exchanges. Those are good for the trading venues, the broker-dealers, et cetera. So I think, rate movement is a good thing. Exactly when and how fast rates will rise, again, I'll leave to the economists.
And then let's just shift over on some of the technology side. You make a statement here in terms of buy side goes best of breed. What's the insight there, Kevin?
Yeah, so this is a back and forth one, and if you read into the text of the report, you'll see that there's sort of two sides to this. But I think, we'll see. There's certainly going to be some smaller firms where they're going to look to buy it all in a box, but increasingly the technology you can get off the shelf, the ability to integrate different products with one another is going to also drive the buy side to sort of piece together what they need, right? To pull in certain elements to create that workflow, workflow for themselves. And maybe the bigger story there is, I think, more and more we're seeing buying of technology off the shelf, right? This isn't the 90s anymore where you had to build everything on your own. And buying off the shelf meant you were using the same thing as your competitor. The products that are available now are so efficient, so customizable, that the cost of building in-house, in many cases, is just not worth it anymore because there's just so much great technology to be bought and integrated.
And the final thing I want to just try to drill down on, and again, the report is the Greenwich outlook for 2017, top 10 insights, and here with Kevin. So Kevin, you talk cloud computing will become simply known as computing. Have we finally passed the hype in the hype cycle where if you just don't have a cloud strategy, you just don't have a strategy at all?
It's a little tongue-in-cheek, but I think we're getting to that point. We're starting to, I think, more in our personal lives, and it's slowly working its way into our professional lives, not even thinking about it anymore, where it's being stored. You just know your information is there and available, and you can get it on any device at any time. And we're finally starting to see a good amount of institutional financial services firms getting there. There's still concerns about regulations and security. We addressed those in a piece of research we did maybe about a year or two ago, that to say that most of those concerns really just aren't that valid anymore. So I think we're getting there. I think we're finally getting over this big hump where the opportunities far outweigh what some participants view as the risks, and we'll see real growth, and it will just become the way that people do business going forward.
The last question for you, Kevin, while we still have you, are the Cubs going to win again?
Sports experts, but hey, I'm a New Yorker, so it's always the Yankees.
That's a good answer, and that's why we keep having you back. All right, Kevin, thank you so much. And the report available on Greenwich.com, top market structure trends to watch in 2017. Kevin, of course, thank you so much for your insights. And of course, we always want to talk about the topics you want to talk about. Please follow us on LinkedIn or on Twitter at NX Analytics. I'm your host, Jim Jockel. Thanks so much.